waiting to see who wins. I always tell the story of my currently biggest winner is a 28 bagger, 29 bagger. I've never taken profits. This is a stock that I paid $7,000 for that right now has a target of 1.2 million. $7,000 to 1.2 million. That's my current target. And that stock, when I bought it, it didn't check all the boxes. It really wasn't even a juicy stock. It really wasn't. It was just a mid-tier producer that had potential. Okay, that one has potential, I'll buy it. That one, 7,000 to 1.2. So, and I didn't know that was going to be the winner. You don't know which stocks are going to be the winners.
Surfer, like become your best friend. Balances in your bank and stack. What's up, everybody? I'm Jared, the Stacking Surfer, and today I've got with me Don Durrett. He's the founder of goldstockdata.com, and I've been following him for quite a while on X. And he's got some great posts that go into some great detail around gold and silver mining stocks. And what I love about what Don brings to the table is he's done a lot of analysis around this. He's not just picking stocks out there. He's got a methodology to it. He also has a great amount of information to share with people that I think is very digestible. And it's also one that can help you, especially if you're considering getting into mining stocks, if you're looking to invest in that area and expand your portfolio outside of just holding gold and silver. So Don, welcome to the show. And we'd love to hear a little bit of your background from you. And, how did you get started into, even investing in gold and silver in the first place, let alone into mining stocks?
Well, a lot of people have heard my story. A lot of people follow me. So I got into gold for the reasons that we're now experiencing. I got into gold because I believed that the U.S. economy and the U.S. kind of global hegemony was going to run into a problem. And that problem is we're kind of seeing today, which is kind of a debt bubble. So I anticipated the debt bubble way in advance, long before the average person. But not only did I anticipate the debt bubble, but I believed in it wholeheartedly, like over 90% confidence that the debt bubble would appear, would occur, and that the winner would be gold. And conversely, so I originally became a gold bug, but then I also became a silver bug, because I came to recognize that silver is a proxy to gold, and that silver is going to come along for the ride. But the big dog here is gold. It's all about gold. My background's gold. It's all about gold, but silver is also coming. It's coming for the ride. It's not going to be left out. So people are getting into gold today for the same reasons I did, is that we just don't believe that this debt bubble can be avoided. And that eventually it's going to pop. And when it does pop, the winner is going to be gold. And we're seeing that today. Gold's at 4,200, near its all-time high. Silver's at an all-time high. And all they seem to be doing is trending higher, which was always my expectation. So everybody's kind of joining the party with me.
I love it. So when you were looking at this debt bubble, about what year did you start to see it? When did it start to really hit into your head and you went, wait a second, something's off here?
This is one that kind of blows people's minds, but I became a gold bug in 1989 because of my research. I came to gold indirectly. I was doing research about the future. I started researching the future indirectly. And I just came across some information that basically said that the U.S. era is going to end in my lifetime, and it just resonated with me. I just kind of connected the dots really early. I bought my first gold mutual fund in 1991. All through the 90s, I was buying gold stocks, buying this gold mutual fund through the 90s. My belief never really increased. I believed that the U.S. was basically going to end up losing its global hegemony, which is currently happening right now. But I didn't really go all in until like 2004. And that's when things really started. 2000, the dot-com bubble bursted, and then 9/11, 2001. 2004 is when I started collecting mining stocks. I'm more of a collector than an investor. I have like 165 stocks. I just collect them. But I've gotten really good at analyzing them, and we can talk about how I analyze stocks.
I'd love to.
I've always thought of it from the very beginning as a trade. It's a lot like the Michael Burry trade in 2005 when he kind of went all in market-backed securities. He basically saw, he was 90% confident he was going to work, and he just went all in. I've been the same way. Since 2004, I haven't really liked cash. It's like if I get cash, it goes into stocks. Burry was like all in, like $100 million bet. I've been slowly accumulating stocks for 20 years, but it's a trade. I've told people quite often that I have a systematic approach to getting in and a systematic approach to getting out. I expect to have sold all of my stocks within 3 years, and maybe within 2, depending on what gold and silver do over the next 24 months. But the next 24 to 36 months, I expect to sell all 165 stocks.
So when you call yourself a collector, the collecting started back in early 2000 heavily. You were doing it a little bit before that. And when you're talking about a trade, you're looking at a period of time here in the next 2 to 3 years where you're going to sell out of those. Am I repeating that correctly?
You're right. Absolutely.
So what would you move into afterwards? It doesn't sound like you'd move right back into fiat dollars.
No, I'm not a fan of the US dollar. As a matter of fact, I'm expecting the current US dollar to be replaced by a digital dollar. And when they do that, if you own fiat dollars, you're going to lose money. So I'm not a fan of dollars. So definitely not there. I'm not a fan of the US stock market. So I wouldn't go there either. So those two are out. So now I got to figure out what I'm going to do with the rest of the money. I have a whole list of options, if you will. But at that point, it's all going to be about preserving capital. I'm basically hitting my number, retiring, and then trying to maintain what I've accumulated. But I'm not going to be a professional investor when I walk out of this. I'm not pivoting into making money. That's not the plan.
I love that, because what I'm hearing from you is, one, you saw a trend that was happening. You kind of waited for it to validate, and then you saw that it was validated. You got all into it. And what I found in my life, I know a lot of people that are billionaires. I know a lot of people that are 100 millionaires and also millionaires. I know a lot of people that aren't in that situation too, but the people that happen to be in those situations tend to make a lot of their money from getting to know something really, really well, diving all into it, becoming an expert in it, and then they focus their passion and energy into it. And then what they typically do is, after they make that money, a lot of them are more narcissistic, to be honest, and they can't pull themselves out of it. So they kind of like die in their passion. But I love this idea of being able to pull back and then diversify yourself in whatever you end up deciding to put into, put this capital into, in a way that spreads out that risk, later on. And who knows, maybe you go into physical, maybe you go into, some other assets. But the key is you're not looking to go into other assets that are going to continue to have that debt issue. And I'm guessing part of why you get out of it is we probably have had the debt bubble pop at some point there. And, people are going, hey, what do I do? And you're in a good position for it. I agree with you. You didn't mention the terms, stable coin or CBDC, but to me, I think it's going to be some kind of a digital asset, like a digital dollar that replaces the US dollar. And when that does come, I think it's going to be hard to get in and out of it, meaning you're kind of in that ecosystem and you're stuck there.
I've learned my personality. I'm a bit of a visionary. I mean, for me in 1989 to basically become a gold bull, kind of gold bug before a lot of people, you have to be somewhat visionary. And I've always been that. So I've always been a fan of crypto because I recognize that it's a technology. A lot of people say that it's air, it's a scam and there's no underlying value. What they don't understand is the underlying value is the technology, and the technology is expanding, it's growing. And so I've always thought that crypto would evolve. It has so much potential, if you will. People don't recognize how much potential it has. And now the Trump administration with the Clarity Act and the Genius Act, they're going to make that potential manifest. And so that's one area that I will definitely invest in. I already have. And a lot of people are getting pushed back. I have a lot of gold bugs that follow me that do not like crypto, that they think it's,
Yeah.
a scam, it's going to zero, it doesn't have any intrinsic value. But I see the technology evolving. And I firmly believe it's really fascinating, because I've been seeing this coming, just like gold, years ahead of time, that there will be a time come when we have money on our phone, and it's our money. It's in our digital wallet on our phone. It doesn't necessarily have to be Bitcoin. It could be a stable coin. It could be a token. But the bottom line is, it's going to be our money in our phone. In other words, no counterparty risk. It's just sitting there on our phone. So if you walk into a grocery store or you walk into Walmart, it's the same thing if it's having cash. You got cash in your wallet, you're going to be able to buy it. You don't have to worry about your credit card being denied, right? And you walk in there, it's there. I think that's going to be a trend that takes off fairly soon. And so it's going to get to the point, and you're going to actually be, I've always said that when the whole financial system is really built around the US government, because the US government it holds everything up. The Fed, the liquidity, the whole thing is kind of held up by the US government, who supports Wall Street, who supports the banking system. It's all kind of integrated, right? Interrelated. Well, if I'm right that we're hitting an end of era situation here, the whole financial system is going to get racked, if you will. And there's going to come a point in time where we're not real comfortable with counterparty risk. It's like, I'm not really comfortable. We're already hearing about people getting cut off of their credit card, right? So you're like, you don't know.
I mean, we're debanked is another.
Yeah, you can get debanked, you can get decredited. And so there's going to come a time when people are like, I want that alternative, money. I want some of that alternative money that I can trust, right? And so I think that's coming, and I think that's, and so in gold and silver actually they actually fit in the same bucket as that, the lack of counterparty risk, and people ignore that. And I've always said that's a very strong kind of correlation. So I've always been crypto and gold, and most people are like, Don, shut up on that crypto stuff. But I don't, because I'm telling you, the people that are anti-crypto are going to end up owning crypto.
I agree with you. So I have Andy Schectman on quite a bit, and we talk about Bitcoin a little bit. We'll talk about XRP from time to time too. Those are kind of the two big ones that we'll mention. And the funny thing is a lot of the people that got into Bitcoin early, maybe not as many of the newest people into it, but a lot of the people into cryptocurrencies, into Bitcoin, are looking to get money out of the system. They're looking to have kind of that self-sovereignty. They want to be able to take control of it. And, as long as that's still allowed, I think there's going to be a lot of interest there. And it's technology. I'm a technology guy. I work for an AI company, and we sell technology that basically every person in the world touches the technology that I work with every day on a daily basis. We're in the Fortune 300 companies. We help run a lot of government stuff. And at the end of the day, technology helps make things move and makes them more smooth and fluid. Now, the only place I have a hard time with crypto, and I think this is where a lot of people have been burned, is people buy it at the wrong time. So, don't get the technology of blockchain mixed up with the price action of a given token or coin. I think a lot of people get that. And so they have FOMO, they dive in at the top of a market, and then it goes down and they get burned out of it. If you understand those underlying, crypto technologies and what they're for, and you're buying them for the right reason, in my opinion, and you look for the right entryways into it, then it makes more sense for the average person. But to your point, I do think by the time we get to a digital dollar, it's going to be as easy as using like Apple Pay or Android Pay on your phone, where it's there. It's like a debit card. It's like accessed into your bank account. There's a lot of talk of even tokenization of gold and silver. So you could potentially have your gold and silver that is tokenized. I would think you probably have to turn it into a bank to do that, but you'd have the ability to pull it back out. So I don't know how that future is going to go yet, but it's going to be really interesting when we get there. In the meantime, looking at the next 2 years, Don, before we get to that point of, what to do after doing the trade, what's your methodology for looking at, what miners to go into? How do you make a decision about how much to put into each of those miners? And, do you kind of have a game plan for someone that's getting started versus someone that's maybe a little bit more mid understanding to someone that's an expert?
So first of all, it's very difficult to understand the risk of the mining stocks. It's not really investing, and this is what kind of throws people for a loop. In a bull market, it's somewhat investing, because in a bull market, the dips tend to not last very long, and they bounce, and you come out of the dip, and so so these stocks can look like an investment, but it's being kind of covered over by the fact that you're in a bull market. In actuality, gold and silver mining stocks are really, really highly speculative, highly volatile securities, which have huge leverage. So, I mean, when I started doing this, the reason why I got into the gold and silver is because I had a very strong feeling that gold was going to be the winner and gold was going to go up substantially. And if that was if that was going to happen, that means the miners are going to participate even better. It's just a matter of waiting for that outcome. So it's highly speculative, but the best way to do it if you're new to this is the ETFs. For instance, right now, I think over 60% of the stocks on Wall Street are passive investments, passive ETFs. That means they're not actively managed. They're basically index funds, over 60%. So that just shows you that it's hard to beat the market. So it's hard to pick your own gold and silver miners and beat the ETFs. For instance, SILJ this year was up 180, year to date, it's up 180%, which is pretty amazing. GDX is up 160%. GDXJ is up 160, GDX up 140. So the ETFs are tough to beat. And so that's really the easy way to do it, is to invest in ETFs. There's 3 silver ETFs, and there's about 8 gold miner ETFs. And there's actually more. That's basically North America based. There's more of these ETFs in Australia and in Europe, that some people will invest in those instead. And then those are just the miner ETFs. Then you also have the physical ETFs on top of those, which gives you even more diversification. So the ETFs are kind of the easy street to do this, to get exposure. But even then, you could have a lot of volatility, especially in some of the silver miner ETFs. You can go down 5% in a day is quite common. You can go down 20% in a week. Some people just don't have the stomach for that. Some people, times, if you go all in. I learned very early on that I don't like to trade. So there's kind of 2 ways. So we got the ETFs out of the way. So the next thing to do is to buy miners. And so there's 2 ways to do the miners. One is you can actively manage, and you can do 10 to 30 stocks. 10's very high, uber aggressive, but even up to 30 is aggressive. If you do 30 stocks, you're going to have to manage those on a daily basis. And you're going to have somewhat high allocations if you only do 30 stocks or less. Mm-hmm. I found early on in my investing career, when I was collecting these, that I don't really like to manage them on a daily basis. I don't want to buy and sell stocks on a daily basis. I'm more of a buy, hold, kind of buy and forget kind of guy. So what I found was the only way I could do that, because I've learned this through the volatility, is I have to allocate kind of small. So what I learned was I take my total cost basis, and I do 0.25 to 0.35 for high risk, 0.5 to 0.7 for very, very high quality companies, and then 0.8 to 1% for kind of rare stocks that I really, really like. But it's almost impossible for a company, for a stock to get more than 1% for me. I don't give companies I don't give stocks 1%. And my average is 0.5. That's what I look. It's kind of funny. I looked it up. My average cost basis is 0.5. Well, it turns out that I also have a thing that there's a couple other, you learn this in my book. I wrote a book, explains all this out, that I have something called a pain point and a minimum allocation. So your pain point is the level that if a company goes bankrupt, and it happens in these stocks you don't expect to go bankrupt, they go to bankrupt overnight. They can go bankrupt literally overnight. If a company, if it's a single asset project and they stop mining, it'll basically stop trading and it'll never trade again. So I have a pain point, and there's my book. Thank you. So this is it's basically a textbook, and it explains it all. So a pain point. I learned that if a stock, because I've been doing this for 20 years, I've learned how much can I invest in a company and it go bankrupt and not hurt me.
Okay.
And so once you learn your pain point, so what happens is the stock goes bankrupt at a certain level and you don't care. Then the stock goes bankrupt at a higher level and you care. You learn your pain point real fast. So once you learn your pain point, you stay at that pain point or lower for anything that has high risk. You'll go above it for a stock you really like. But if it's high risk, you don't go above it. And that's helped me a lot. And then the second thing that's helped me a lot is a minimum investment. So you only do the minimum investments for stocks you really like. So I've learned, I take my portfolio and I sort it by current value. Now the 0.25, the 0.5, and the 1%, that's off your cost basis, your total cost basis. Your minimum level is valuation. So what I do is I'll sort my portfolio quite often lately by valuation, and then I'll go all the way down to the level that is my minimum level, and I'll look at any stock below that minimum, and I'll write it down, and I'll add to it. So those are kind of my rules of thumb.
I think at least my tendency with stocks, and I've been in the stock market since about '98. I was pretty young when I got into it, but I come from a banking family, and we had access to more things back then. And one of the things that I find is it can get really easy when you believe you're in a dip to overbuy and throw off like those percentages. How do you keep yourself from, getting out of whack with those percentages? What do you do when you're starting to add to them?
So for me, the key is when you buy, right? That's when you make your money.
Oh yeah.
And it's also when you create risk. And so you don't want, so when you buy, you're paying attention to my rule of thumb, 0.25, 0.35 for high risk, 5 for, quality, and then, 0.8 for uber quality, right? So you pay attention to those for when you buy. Now, when you buy the dip, you're right. This is actually a good question, because I actually made a mistake on this once.
I've done it before.
So what'll happen is that you'll go to one of these high risk companies, you'll go in like 0.35, and then it drops by 70%, and you still like it, and you'll add to it. Now you're at 0.5, but it's still high risk.
Yep.
And so that's a good point, Jared. So you got to be really careful. You don't, and this is where you only want to add to it if you really like it. So, I basically don't buy stocks if they drop 50%. 50% for me is like nothing burger. That's my minimums, right? My minimum. If I'm below my minimum, I'm adding to it. But if a stock drops 50%, it goes up 100%, you're back to normal. So if a stock goes below 50%, at that point, you're looking for an opportunity to buy the dip if you still like it. And I do this quite often. But you got to be careful with your allocations. So the key here is you got to like it, and it's got to be a good company. In other words, you're not chasing a lottery pick just because a lottery pick went down 50%. You're like, oh, it went down. I think I'm going to add to it. No, you add to the stocks that you like.
Yes.
Again, you make your money when you buy. You de-risk or add risk when you buy, and so buying is really important. And then I've learned, it took me 20 years, well, less than that, but now I've done it 20 years. Now I know it better. I've learned how to get an edge. Now, it took me a long time to do this. So in my book, if you buy my book, in the appendix, it literally tells you how to get an edge. So there's 3 categories. There's actually 4, but I kind of ignore one. One is the exploration stocks, the others are developers, and the others are producers, those 3. The 4th is royalty stocks. Kind of ignore those. So the exploration stocks, I have 2 rules. And if you follow those rules, you're basically not going to be chasing any lottery picks. We eliminate the lottery picks. You follow, and I have this in an appendix in my book. So the 2 rules for exploration stocks. The first rule is you want to buy it if it's an optionality play. And an optionality play means you're basically buying gold and silver in the ground below market. And so it's really hard. It's like an arbitrage situation.
Yep.
So if you can find a company that's got gold in the ground for less than $20 or silver in the ground for less than $2, and they have a lot, you don't want to do an optionality play on a small deposit, but it's a pretty good sized deposit, and you can buy it well below market, and you just know as long as gold and silver prices go up, you're going to make money, and the odds are it's not going to get any cheaper. So I like optionality. As a matter of fact, most of my exploration plays are optionality. These stocks can really rip, and it's like an arbitrage play. You're not really going to lose money. The second rule is you want to buy early in the Lassonde curve. The Lassonde curve is basically it's a curve that goes up and down like a mountain of the share price, and it starts at the very bottom of the mountain, on the left-hand side, and it goes up the mountain. That's the discovery phase. So you want to buy early in the Lassonde curve, so it's cheap. And you only want to buy it if it has an excellent drill hole. And what an excellent drill hole is gram meters. So the minimum is a gram meter hole of 200. So if you follow that rule, you have an edge. Now the next one are developers. So in developers, I have 6 buckets, 6 different check boxes. If a company doesn't check all 6 of them, then you pass, or you gamble. So once in a while, I'll find a company that doesn't check all the boxes, but I'll still gamble on it. But most of them, if they check all the boxes, you're going to have an edge. So, and I have those 6 boxes, and I tell you exactly what the 6 boxes are. Doug Casey uses 10, I think, or 9. I think he uses 9. Excuse me, he uses 9. But he uses 9 for, I think, any company. So in this one, I have 6, and they need to pass them all. And then producers and the each one has a different list, but there's a little bit of crossover, and then the producers, they're the same. They have these check boxes, and you go through, and for each one of the check boxes, you want to do a ranking like 5 through 9. 5 is weak, 9 is really good, and you look in you don't want any 5s or 6s. So you want 7, 8, 9s on each checkbox, and you go down the list and you basically rank them. If you can find one that's all 8s, or mostly 9s and 8s and maybe a couple 7s, that's how you get an edge. And I've learned how to do that, and it's helped me immensely. And the thing is beautiful about it is that you can find companies that are 10, 20, 30 baggers at higher gold prices that check all the boxes. When you find those, you just buy them. I mean, that's how I collect stocks. Yeah, find a stock, buy it. Find a stock, buy it. And the other thing, here's another nugget for people. This is a hard one for people. You don't try to pick winners in mining stocks. You don't know who the winners are. The reason why you don't try to pick winners is because you don't know who the winners are going to be. All you can do is pick potential winners. And so you're not married to these stocks, even though I created a group called the Mormons. You can marry all 6 of them, but 8 of them actually. Most of these stocks you don't want to marry. You don't want to have any emotional commitment to. No emotional commitment. So I basically have low allocation. Buy it and forget it. And now one last nugget: you say no emotion, no married. You're not committed to these stocks. You're just waiting to see who wins. I always tell the story of my currently biggest winner is a 28 bagger, 29 bagger. I've never taken profits. This is a stock that I paid $7,000 for that right now has a target of 1.2 million. $7,000 to 1.2 million. That's my current target. And that stock, when I bought it, it didn't check all the boxes. It really wasn't even a juicy stock. It really wasn't. It was just a mid-tier producer that had potential. Okay, that one has potential, I'll buy it. That one, 7,000 to 1.2. So, and I didn't know that was going to be the winner. You don't know which stocks are going to be the winners. Got another example. I'll use one more. Is Coeur d'Alene. Coeur d'Alene was trading at $2 back in November of 23. It was trading at $2, and I told everybody buy this stock because when silver prices go up, Wall Street's going to buy this stock like candy. You wait and watch. They're going to buy it. They're going to buy it, because of the location of the mine. And nobody. I'm not buying that stock. It's a dog. Management sucks. I'm going in a bull market, and now I have it ranked number 1 on the silver mining list.
Yeah.
Now the reason why it's ranked number 1 was not when it was at $2. It would not be ranked number 1.
Okay.
But this is what I mean by you don't pick winners. You let the winners appear. They acquired Mag Silver, and it completely fixed the company. It was a game changer. That's all it takes. Another game changer was First Majestic. They acquired Gatos. These are game changers. Pan American acquired Coeur acquired Silvercrest. Sometimes I confuse these. They acquired Silvercrest, and it lowered their cost. Pan American, Mag Silver, increased their silver production. Gatos lowered their cost. When you buy these stocks, you don't anticipate that they're going to do an acquisition. You don't know. These companies, they bob and weave. They sell this project. They buy that project. Equinox just sold their projects down in Brazil, but now they'll buy something else. You don't know who your winners are going to be. So it's really, really difficult. People are trying to pick winners. They don't know, especially if you have I see a lot of people that have a portfolio of juniors. They'll have like 25 silver juniors, and the average market cap for these stocks is $50 million. They have zero idea which one of those stocks is going to be the big winner. Zero.
Well, so here's the key. So some of the people watching this are going to be learning a lot for the very first time. They may not even end up getting into mining stocks. They may just be curious about it. Right. We're going to have other people that are watching this that own a bunch of mining stocks. I just heard a couple big keys that I just want to point out. Besides the rules, the idea of not picking a winner, I think, is huge, because I think too often when we're investing in equities in general, we're always trying to find that winner, right? We're trying to figure out, is Microsoft, if I talk tech here for a second, Microsoft or Apple, or is it going to be Adobe, or is it going to be Google? Which of these stocks is going to be the one that becomes the top company that's out there? And it's a different game. Those all have proprietary, protected software and devices and things that they're going to create that no one else can get anywhere else. When you're talking about gold and silver mining stocks, you're talking about the same, metal that's coming out of the ground. You mentioned, leadership teams, right? Leadership teams can be different. Management can be different. Are they spending all their time drilling in the wrong part of the land that they own, and they're not finding things, right? So there's other risks that can come into play. But, I think it just attests to that whole idea of having more companies instead of focusing on, say, 5, 10, 20, or even 30 of the miners that you're looking at, especially if you spread that out. If on average you're 0.5% in any one given company, you're not really picking a winner there. You're hoping to see who comes out of that. So I guess another question I'd have for you, Don, in that same thought process is, when you find out like Coeur d'Alene is starting to move and take off, did you put more money into it, or did you just ride it?
No, I do not press my bets. That's an Eric Sprott. He does that. And I just keep adding more stocks. But what I do is I stay above my minimum. So, if Coeur is below that minimum, then I'm going to add to it. And I'm constantly looking at my stocks. I don't want to be underweight a stock that I like. Okay. And so that would be that. But I'm not a press my bet kind of investor. I'm more of but the irony is that these stocks have so much leverage, if you will, that they tend to grow massively over time. I look at my portfolio now. So I showed you that one stock that had a 28 bagger. I have several others that are like, 10 baggers that, so they get really big, if you will. So you don't need to press them. I found that I don't necessarily need to press them. They get big. They can get big in a hurry. There's a lot of leverage in this, in these miners.
So when you look at that, what do you ever? You mentioned you haven't sold anything out of the 38 bagger, right? You're still holding it.
Yeah.
You haven't taken any profits yet.
No, 1.2 is the exit.
But that's going to throw your portfolio off as far as a percentage of all of the rest of the stocks you have, correct? Like, is that going to be much higher? So,
right.
What do you do there?
I thought about this. It's the one that has the 28 baggers, Agnico Eagle. And
28,
I thought about taking profit, taking something off the table on it, but I'm comfortable with Agnico, even though Agnico could get in trouble if they lost one of their big mines. I believe they would recover because it's such a good company and it's a growing company and it's diversified in many different countries that even if I don't think they're going to lose two mines, if you will. So the big problem for a lot of companies is they only have one or two mines. If you lose one, you go down 25% and, you might not recover for 2 years. But Agnico is probably the elite miner. I really wouldn't put any company ahead of them at this time. I would rank them number one. I create this one stock, basically the Elite Eight. And the Elite Eight, they are the number one stock in that bucket. So your Elite Eight is off the top of my head. So you got number one would definitely be Agnico. And then after that, you'd have Newmont, and then you'd have Barrick, and then you have Lundin, you have Goldfield, you have Northern Star, and Kinross. Those are the big, major, high-quality elite names, and I put Agnico at the very top, tippy top of that. So this is a one company that I don't have any problem. But then another company I haven't taken profit from. Well, actually, I took a little bit, but not very much. Is First Majestic, and a lot of people are like, at a certain time, it was kind of dicey there for First Majestic. I mean, they weren't performing very well; they had a high cost. But then they did the Gatos deal, and the Gatos deal kind of got them back on their feet, and now they're trending in a good direction. But my position in First Majestic is a lot more risky than Agnico Eagle. And then I have a big position in Hecla, and that's another one. If they have one problem at one mine, they could drop. And I have some big positions in some other places as well. But most of my big positions are in quality producers. But I'm not going to take anything off the table. I have sell targets. That's how I'm exiting. That's my systematic way of exiting. You mentioned earlier management as being important. Absolutely, that's one of the check boxes.
Yep.
That's in both check boxes for producers and developers, by the way. So you want to rank the management team, like I said, from 5 to 9. And that's important. That's a really important checkbox.
So when you're so a couple things I wanted to ask you a little bit more detail. But before we get there, I wanted to show everybody your website just so that they can see that too. I've actually been using the kind of the term of a Swiss Army knife recently too, in a lot of analogies. But I think it's very important to have support, help. Don't go all this alone on your own. As I look at things, the stock market. I talk to other people that go into heavy charting in general, and they're seeing, it looks like a capital rotation is really starting to happen, but it's not confirmed yet. From equities into gold and silver, maybe we're having somewhat of a Bitcoin into gold and silver rotation. We're not sure on that yet either, but we know money's been moving in and money's been going down in some of those other areas. What I do see, though, based on this debt bubble and all the issues that are going on, and with the lack of being able to even afford to service the debt, it does look to me like gold and silver is going to continue to have a really good movement up for the next several years. And to your point, if you spread your risk out across a lot of different companies that are out there, you don't have to pick a winner, right? If you're only picking 4 stocks, you kind of have to pick a winner, or you're not really going to go anywhere. if you can diversify and pick a lot more stocks and have, like you said, your percentages and have your, strategy in place. And then, if I have, for example, for me, if one really blows up, I kind of take it out of the equation and put it over to the side, so that I make sure my percentages are in alignment for the rest of the companies that are going on. But what do you offer on your website that helps us kind of, follow what you're doing, helps us get a little better understanding of, where to find the research, how to figure out which of these mining companies we'd be interested in? Because I know, as always, this is not financial advice. We're just looking through how we can best support each other with tools, guys, to make the decision. Don's not going to tell you what to do. I'm not going to tell you what to do. You guys have to go do that on your own, and you're going to take your own risk. There's risk that you can lose money here. There's also the ability to make a crazy amount of money, much more than you can just holding gold and silver coins, bars, or rounds in your possession. This is another part of your stack, so to speak, that can really, or your strategy that can really help you increase your wealth and be able to get you to the point where you can, build your stack where you want to go. But I'd love to have you share a little bit more with how your methodology works as far as the service that you offer. I see 1, 2, and 3 in here listed in a couple different options.
Right. Well, first of all, it's a bit different type of a website in that we're not a trading website. We're not a stock picking website. We don't give buy and sell signals. It says data, gold stock data, right? So this was I created this, but this is what I wanted when I started investing. Okay. I just want, so there's 850 stocks in the database. So I want, basically, tell me all the mid-tier producers in the world, tell me all the silver producers in the world, and then tell me their cost, give me data, right? So that's where it came from. But the beautiful thing about the website, if you will, is that I rate every company. So I don't want people to basically buy all the stocks that I have the highest ratings on. But I want you to look at them and find, for instance, the highest rated companies, I color code them. They're green. They have an upside rating of 4 and they're green. And then they have a quality rating of, I don't have anything that has an A, but I have A- and B+. Those are like the best of the best. And so I have these lists, and you can go in, you can see the list, of the stocks that I highly, highly rate. But I want you to understand what you're buying. I want you to basically say, okay, Don, he's got like 15 of these stocks that are best of the best. Of these 15, which ones do I like, right?
Yeah.
And why do I like them better than Don? Some of my stocks are in locations that you might not like, because I don't really mind West Africa. And some people are like, oh, I don't want to buy anything in West Africa, or I don't want to buy anything in Peru. And so there's certain countries people will not want, but I want you to do your own analysis. But the power of the database is the search engine. Like I said, show me all the silver miners in the world. That's very powerful. And then the ratings that go with it. So I'm up to 2,500 subscribers, and the support is actually becoming somewhat difficult. It's like information overload. So I actually had to raise my prices to slow it down. If I wouldn't have raised my prices, I'd be up to 5,000 subscribers, and then I'd be buried in support. So I raised it to slow. I just slow it down a little bit. But everybody that joins it, you can read those testimonials. I get all the time. People absolutely love the website, and so there's nothing else like it out there. It's a very, very useful tool. Let's put it that way.
What's the difference between the standard and premium versions?
So my website partner, he wanted to do some enhancements a while ago, and he said, "Okay, I'm going to do these enhancements, but I don't want to give them away. I want to charge a premium." And so I said, "Okay, we'll do that." And so there's all these enhancements that he had. We threw those in the premium package. So the biggest one for the premium that I think it's worth the extra $100 is you get a drop down of about 20 searches that I've created, like all the searches in the newsletter. There's about 10 lists in the newsletter. You can actually run those searches if you have the premium, which is, I think that alone is worth $100. In other words, my favorites list, I have a personal favorites list with 84 stocks that I own all of. That's a beautiful ETF, if you will. You can run that search, and then you can look at all the data that's associated with those 84 stocks. The website is named correctly. It should be called Gold Silver Stock Data, but it's Gold Stock because it definitely has silver involved. But the amount of data you get is pretty phenomenal. It gives you a lot of information to make decisions on. It's a good starting point. I always call that it's a good starting point, for any investor, anybody that's already investing in mining stocks. It's like a little helper tool. Like, okay, he likes this stock. Here's some data. Now let me go confirm the data. This is the most information I've ever really shared with this website, which is pretty phenomenal. One last thing I'll say on the website, we'll move on, is it allows you to do target prices, and they're called alerts. So I have 25 alerts set up, and it's growing, of my exit prices. So it'll email you when the stock hits a high price or a low price, hits your targets, you'll get an email. So I keep setting up these targets, but you can do it for like buy the dip option. Like you say, okay, I want to buy core at $14. You just go in there and stick it in there, $14. You'll get an email when core hits 14. So those two things are the biggest premiums.
One of the reasons I started this channel is to help a lot of other people, but I'm a little selfish. I also want to help myself. And so I get to interview great people, and I get to dig into my own questions I have and ones that I hope help other people. But, I think a lot of people come to a website like this in general, and being in this space, people don't always know where to get started. They're kind of curious on what's going to happen with it. Do I sign up for standard? Can I upgrade to premium? Anyway, it's always helpful to give them a little sense of, what's out there and how they differ. So the last point, go ahead. Sorry.
I just want to say that a lot of people join for the wrong reasons.
Okay.
A lot of people, the purpose of the website is to use it as a tool for you to analyze stocks. It's called gold stock data. It's not gold picker data,
Yep.
Gold stocks for you data. That's not what it is. So a lot of people sign up. I get emails all the time from people. This is what I was looking for. This is what I was like. The average person, they want you to say, these are the 10 stocks I love. This is the ones. I actually don't write up stocks in my newsletter. My newsletter doesn't write up stocks. The first 5 pages of the newsletter is macro data, because if you're going to invest in stocks, then you need to understand why you're investing. Do I want to buy now? Why do I want to buy later? The macro data is really important if you're a gold, silver miner investor. And then the rest of the newsletter are lists. They're just a list of stocks, and you can leads, if you will. So I have all kinds of lists. I have a 5-bagger list, a 3-bagger list, a 10-bagger list, a developers list, optionality list. So I have all kinds of lists for people who are, what you're looking. I have a silver stock list, Canada list, Australia list. So I give people lists, but I'm not writing up stocks and saying, okay, here you go buy this one. So people buy for the right reasons.
I think it's awesome. I've got a small friend group from high school, and we get onto TradingView, and we go through multiple stocks that we like. It's an investing group. So we look at stocks, we figure out which ones we want to put in our money into. We've looked at things from AI to cryptos, not really stocks, but cryptos. They're starting to look into mining stocks. I'm starting to get them to consider these as well.
So use my website and look at my best of the best. Let's go analyze Don's best of the best and see
we're going to do it.
See why we like it. So the upside green.
Yep.
So the upside is green, and then the quality either A- or B+.
I love it. So here's where I was going with this, Don, is for people, investing in general. Day trading is a whole different thing. I'm not even going to go there. Let's talk investing. When you're investing and you're looking at stocks, if you're someone that isn't willing to take the time to research, if you don't have other people you're potentially working with, like this little investing group I'm describing, or utilizing tools like you have, Don, my recommendation is to look at more like ETFs for people. If you don't want to do a lot of research, but you want to get exposure to it, and you're just looking for something to ride the wave with, but you're not willing to put all the work into it. To me, that's more of an ETF. If you're going to go pick individual stocks, I want to know the data. It doesn't help me to just have someone throw out 30 names and I go buy those 30 names, because if I do that, I just buy them because someone told me. I don't know what I'm looking for to see if they're improving or if they're getting into trouble. And you want to know those things and start to understand that well ahead of like a major problem happens. And all of a sudden, for example, like you mentioned, one of the mines closes down or there's an issue with it, right? You want to be able to know that those things can happen. You want to be keeping an eye out for that so you don't run into any major issues. But I think that's one risk that people take when they're looking at things like stocks, is they don't take into account that this isn't a get rich quick scheme. This isn't something that you just buy and hold. You need to understand what you're in. You need to understand why you're in it. Why did you pick that stock? And then, like you mentioned too, Don, and my grandfather always said this: you make your money when you buy. But it's also super, super important to understand what your exit strategy is and where you're going with it.
You should have an exit strategy for every stock you own. I
Yes.
mentioned that in my book. And so, we are actually we're getting really close here to approaching that period. We're still early. But once Newmont right now, their free cash flow multiple is about 9. It's like under 9, 8 point something. When it gets to 16, 17, 18, somewhere in there, we got a ways to go. We got more than a year to go, I think, depending on what gold and silver do. But I think we're about a year away before we even should even consider exiting. So we shouldn't even be thinking. We shouldn't even be thinking about it. We're early. So, but once I think I use free cash flow multiples, equivalent of a PE for regular stocks. Regular stocks are real businesses. These are companies that are oddballs. I mean, so I use cash flow. They're cash business. Free cash flow is huge. And the reason why they're such weird businesses is the price of gold has an overwhelming impact on the company, on the valuation of the company. Yep. They don't have customers. They have buyers. Nobody knocks on the door. Do you have any gold for sale? They basically have a list. Okay, who are we going to sell to today? Okay, we got A, B, C. Who are we going to sell? They have buyers, right? It's easy peasy to sell this stuff, right? The other thing they don't have any competitor. They don't compete against anybody. They just compete against themselves, right? They go out there and they find the gold, they get it out of the ground, they sell it, right? You don't have any competitors. You find a gold mine, it's your mine, you're mine. So it's a weird business. And so I use free cash flow is much more important than profit, because cash is king in this business. So I use the free cash flow multiple, but it's very similar to PEs. So PEs, when a PE gets lofty, like today, the S&P is around 22, 23 forward PE. And we all know that's way above its historical norm, right? We know it's lofty, right? Yep. Well, the miners they're in the dumper. I mean, they're really, really cheap from a free cash flow multiple standpoint. In 1980, the average was 22. And right now, the average is 9 for a producer and 9 for silver miners and 7 for gold miners. I think that it's going to go into the high teens and maybe in the 20s. So we're early. So my point is that we have about a year, 6, 9, 12 months, at least 6, 9, 12 months before we even have to think about our exit strategy per se. We can get ahead of the curve here, like I'm doing my exits, but we will be exiting, hot and heavy here in about 12 months is my expectation. So my 84 stocks will start shrinking. That favorite list, as I sell, it'll start shrinking. It's at 84. It'll go all the way. I think it's going to go all down to sub 20. So I'm going to be selling 64 of those names over the next, 12 to 36 months is my expectation. So yeah, you got to start thinking about that, but it's way too early to be selling. Last Sunday, some guy told me that he was going to start selling. He said, I'm ready to start. And I told him, No.
Don't know.
We're way too early. We hadn't even
Yeah,
started
I've
yet.
got a lot of people coming in and saying, "Hey, we've hit the top. I need to get out." Now,
Let's
can
wait.
mining,
Let's wait.
yeah, can mining stocks be a good sell before gold and silver tops, or are you anticipating a top in the next year or 2 to 3 years in the metals themselves?
I am. I'm. People are calling me. You know, I'm always been called the most bearish bull, the most bearish gold
Okay.
bull, because I'm always talking about the next cycle low. Like right
Okay.
now, I'm talking about gold's at 4,200, and I'm talking about gold going down to 37, around $3,700 is where we're going. We're heading to 3,700, and people are like, you know, they're all growling at me saying, "Why are you so bearish?" Silver's at 63, and I'm basically saying we're probably going to go down to 45. I've been telling everybody,
very possible. Yep.
expect a 20 to 30% correction. It's going to happen. Be ready for it. You know, I'm talking about that. Now, as far as the top, I always say that we really shouldn't take any profits before $5,000 gold.
Okay.
$5,000 gold is easy peasy. So until we get to 5,000, so two things have to happen. First, you got to get to 5,000. And then the PE on Newmont, as long as Newmont doesn't have any problems. But Newmont's PE its multiple needs to go up. So if we get to 5,000 and its multiple is still at 13, it's still too early.
Got it. Okay.
So,
I like that.
So you get to 5,000, you have to look and see how's Newmont doing. So my target price for Newmont's $350. Well, it's not going to get to 350. So it's currently about 95. So if its multiple doubles from 9 to 18, then it'll go to $190. So it needs to get to around 175, 200, somewhere in there before we even start thinking about maybe taking some profits. Probably 200, but I think 350 is where it's going. Now, my targets are somewhat conservative because I'm doing that at $6,000 gold. I think that $6,000 gold is actually too conservative, and a lot of people are telling me I'm way too conservative at 6,000.
I'm hearing bigger numbers. Yes.
Yeah, we're hearing bigger, but I think that between now and the end of 28, I think we see 6,000 plus, and so that's where my targets are. But if I like to use the SGR, the silver gold ratio. So you divide silver by gold. It's because it's real simple because the 1% is easy, right? So you just do 1%. So if you take $5,000 gold at 1%, it's $50 silver. But if you do 2%, it's $100. And I think that's kind of where we're going to be. When we get to 5,000, 2% is actually norm. We were actually almost at 6% in 1980, almost 6.
Wow.
So I think 2.5 to 3% is probably where we're going, but at $5,000 gold at 2% is $100 silver. So I think we're going to be, when we get to $5,000 gold, I'm expecting silver to be somewhere between 80 and 100. And so that is going to be a good time to take profits for the first time, but we might want to be a little patient depending on what Newmont does. So the two things we're looking at for confirmation is that SGR, how close to 2% are we? And then we're looking at Newmont's free cash flow multiple. How close to 16 is it? So those are kind of, targets that we're looking for our first exit. And then once we get there, first you got to get to an exit point. And then once you get there, then you have to decide, okay, which stocks am I going to sell? And we want to use the Peter Lynch strategy. Peter Lynch said, my worst mistake as an investor, remember, Peter Lynch was probably the best investor. Nobody outperformed that guy. He said, my number one mistake as an investor was selling early. Right? That was his regret, So we don't want to sell stocks that are doing really well, that still have really good fundamentals. We don't want to sell those. Unless they've hit these, bazillion targets, like my 1.2 million on.
You want to take profits at the right time, and you want to still take profits when it's appropriate.
Yes. So it's a mistake. Selling early can be a mistake. buying, you buy to make money, but you also sell to make money. And so you don't want to sell early. You want to be stubborn. You can't have my money. I see people all the time. People don't realize that if you sell half of your stock, you gave away half of your upside.
Yep.
People don't realize that. It's free money now. I hear it all the time. Now, that's investing. That's investing 101. That's when you're investing over a 20-year period. You're constantly taking profits. You're constantly trying to get your bag bigger and bigger and bigger, right? That's investing. That works. We're not investing. We're speculating. This is a trade.
We're riding this massive gold and silver wave.
Yes.
And waves don't stay up forever. Okay.
Right.
They do come back down.
Right. But
we're going to ride that thing. Yeah, exactly.
As long as it's still going higher, you don't want to get out too early. So you gotta to do the homework. That's why I do 5 pages of macro for each month. I want everybody to understand the macro situation so you can decide when to exit. You can become more comfortable. So as long as the fundamentals in gold and silver remain strong and the miners remain strong, then you don't want to leave too early. And so, but I'm leaving, ironically, I've already told people, I'm planning to leave after my portfolio doubles and doubles again. Because that would be, for me, that's a 7-bagger. And when I started doing this, my goal was a 5-bagger. But if I double and double again, it's 7-bagger. So I'm like, that's good enough. I don't need to double again. That would be a 15-bagger. I'm like, I don't need that. That's enough. So I'm gonna exit early. Once I hit my number, I'm out of here. But a lot of people, I know I'm gonna leave a lot on the table. I know I am, because I've done the analysis, and my analysis says that if gold gets to 6,000, as long as the multiples get higher where I expect them to get, I should double and double again. And that's the plan. I'm hoping, to double in 25 and then double in 26 and then double in 27. That's the whole plan. Yep. I'm hoping to get out in Q4 of 27. Fingers crossed.
I think it's awesome. I bring up my grandpa from time to time because he's one of the best business people I ever knew, and he was very, very successful with what he did. And he always, these aren't just his sayings, but he told us this all the time growing up. Pigs get fat, hogs get slaughtered. And I've seen it in the market. I think way too many people that want to trade or they want to be investors, they get into it for the wrong reason. They're trying to save fees, so they don't use a broker, for example, or an advisor, and I'm going to do this all on my own, but they don't take the time to always do the research. And so one thing I would tell you guys is the reason I brought Don on here, because I reached out to him, is I want to be able to give you more tools to use if you're considering to do more mining stocks. If you guys like the content of hitting more mining stocks too, we can do more about that. But I think it's hugely important to have a strategy in place. You make your money when you buy. Of course, you're going to need to sell at some point to actually realize those profits, or they're just paper. And the last thing I'll say is markets go up and down. So the reason I use the wave analogy is, as a person that surfs, you have these sets that come in, and they come in, say, every 25 minutes, every 20 minutes, depends on, the wave pattern. But it starts like any other wave, right? There's a bell curve to it. So you get little waves that start coming in, and then you get a couple big ones, you get a big, huge one, and then it starts to come back down. And that's what we're going to see. We're going to see these waves of gold and silver moving up, and then we're going to see them coming back down, and then the next one moves up. And so those are your inflection points. If you do a lot of what Don's been talking about here, and you start to understand the data, you don't end up buying at the top. You have patience, and you wait to buy on some of these pullbacks, which then give you that ability to realize more. Because I think what happens, Don, is a lot of people just FOMO, and they're like, oh my gosh, it's hot now. I missed it. I got to hurry and jump in now. And then all of a sudden they get burned and they pull back out, or they make some money in one stock and they see another one doing better, and the one they have isn't doing as well. So they move back over to the other one. And that's what I love about your strategies. It's not about trying to play your stocks against each other. It's not about trying to pick the winner, as you said. It's about kind of diversifying yourself in one area, and being able to know enough about those stocks that you feel comfortable, you can sleep at night, you got your strategy and plan. So I love it.
Yeah, I wanted to mention something about the pigs get fat and the hogs get slaughtered.
Yeah. Okay.
And the reason why that saying has been kind of accurate is that usually a bull market ends in euphoria, and
That is true.
everybody's
That's very true.
everybody's in the market, and then you get rug pulled, and then these bear markets last years. I mean, if you go and you look historically, bear markets can last 5, 10, 15 years. The last bear market, people don't realize this. They just have this normalcy bias of what's happened recently. But if you look at like NASDAQ or the S&P in 2000, the top, it basically didn't do nothing for 12 years. It didn't really get back on its feet till 2013. It was a decade bear market, and people don't realize that. These bear markets, when they peak, so if you were in that market and then you stayed in it, I mean, you waited, people did really well that got into the market in 2009, but the people that were still in it in 2000, they still, like I just saw where Bank of America just hit a new all-time high. The last high was 2006. So sometimes, so what happened? My point is this, is that the fundamentals, you want to ride the fundamental wave. Right?
Yes.
So right now, the fundamentals for gold are very, very good. Well, guess what isn't really good? The fundamentals for the S&P 500, in my opinion, are absolutely terrible.
I think it's going to rotate. I think you're going to see a lot of money rotate. And I do a lot of real estate investing right now. I've pulled out of most of my real estate investments. The ones I bought in early 2000s did really well. The ones that I bought in 2006 not do so well.
Right. Well, the hogs are going to get slaughtered here on the rug pull.
Yes.
Because everybody's in the market. And then everybody is the normalcy bias. Everybody says, well, you got to stay in the V-shaped recovery. All we get is V-shaped recoveries, right?
Oh, don't assume that's going to be what happens next, guys.
But everybody, most people, that's where the hogs get slaughtered thing, because the fundamentals don't support the market. You got a P of, forward P of 22 or 23, doesn't support it. Whereas the gold mining. So the reason why I'm confident is the fundamentals. That's the reason why. So I'm not chasing a bull market or a frenzy market, if you will. I'm chasing the fundamentals. If you look at silver deliveries, right? Silver deliveries have never been at this level, and it just only seems to be getting bigger. Gold purchases by central banks, never at these levels, right? We're seeing Brazil and Korea buy gold, which they never have. More and more accumulation. And so the fundamentals, that's the reason why we're in the gold and silver trade. And like I said, a lot of people are going to treat it as an investment. They're probably going to get lucky because there's a bull market. In a bull market, you're probably going to make money. And that's the one thing that kind of bothers me is people are basically, they don't really understand it, but they're jumping in because they see the opportunity. They see that this is a bull market. This is a trend. It's a they're doing the FOMO trade, the MOMO trade, and they're not really doing it systematically, fundamentally. And that's why I tell people, read my book, so at least you understand what you're buying. Now, I don't make money on my book. I make peanuts on my book. Make money on my website. Make more money on my website in 1 month than I do in the book all year. And so the book's peanuts. The book's for you guys. Like you say, you do your channel to help people, educate people. Yep. I wrote my book because nobody else had written it. I wrote it for other people. I created my website for other people, but I can use it simultaneous because they're tools that I wanted when I started out. And so I did it for the same reasons as you. And I get a lot of credit for that, for basically being out there helping people. I'm making money investing in these mining stocks, but I'm bringing people along for the ride. But the irony is that this is a short ride, and you better ride it now because, like you said, once the wave goes over, it's probably over. We only have 2 to 4 years of this bull market, and then it'll be over and done with, and it's over, And then I really, some people think it's going to last much longer than that, and I hope it does, because I'll end up holding a lot of physical out of this. So I hope it does, but I think that gold mining stocks, I don't think it's going to be the easy trade that we're currently experiencing.
Yep.
I actually think, for us, they got in early. Last year was kind of an easy trade. I mean, SILJ up 180%. But I think that once we get this crash in the S&P, and I think it's going to happen in Q1, once we get that, the next trade is actually going to be the real easy one. Because once that S&P gets out of the way, gold is going to have nobody in front of it. That's the blue sky starts. Right now, the headwind in front of us, the big event in front of us is that S&P 500 crashing, because that's going to pull down everything. But once that's out of the way, everybody's just going to jump into the miners. Going to be just, woo, here we go. That's the easy trade. That's the wave. That's the wave that you want to ride.
It's true. So I think now's a good time for everybody that's watching this to get your research in place, to get your thesis in place, your thought, your idea. Is this something you want to do or not? I also think it's a good time to start learning. So what I noticed too on your website is if you guys sign up for the website, you get the book free. I would definitely read that. I'm going to go do that myself, by the way, because I'm always looking to learn. I've got a master's degree, and what it taught me to do the most was how to learn. It taught me how to analyze. It taught me how to think critically. It taught me how to ask a lot of questions, and then how to think through the process of, where can I find someone that's smarter than me on this subject that I can learn from, that's going to be able to help me be more prosperous. So that's always been kind of my, methodology on it. But Don, I want to thank you so much for coming on. We'd love to have you on again at some point here when you're available. And for anybody that's watching, give us your feedback. Let us know, are you guys in mining stocks? Is this something that's helpful for you? Are you looking to add more miners? What do you think about, remind me how many you have again right now?
About 165.
165. So I love that approach. And I think it's something that you've got to be able to spend some time to get into and deal with, because that's a lot of companies that you need to research. Don's done a lot of research for you.
Yeah, I don't recommend 165. That was just one of those things that I've been doing it for 20 years. I recommend 30. Okay. If you can trade, if you can buy, if you have a mentality that you can monitor your stocks and buy and sell on a daily basis, I think 30 is the way to go, because you're not really trying to pick winners, but you can pick the 30 best stocks you can find. And then what you do is you take those 30, that's your active team that's playing. Then you have like 10, then you have 10 other stocks on the sideline. They're not playing, but you're monitoring them. And then those 30, if one of those 30 stocks starts to play poorly, you swap it. You take the good player in, you put the bad player out. That's the best way to do it. But I can't. I don't have the mentality to do that. Now, if you have the mentality to be an active manager on a daily basis, go for it. But pick the best 30 stocks, right, that you think are the best, and let's see how they perform. Now, if you can't do that, then I recommend 50 to 80. Okay. 50 to 80 is a buy and hold strategy. And then those stocks, the only time that you're going to sell them is if the story changes. So you're just going to hold them. So you wait and then the story changes. Now, if a stock goes down 50% and the story doesn't change, no harm, no foul. But if the story changes, you buy a stock for a reason, for a story. You analyze it, you analyze the story of the company, and you buy it for the story. If that story changes, you sell the stock. I sold the stock today. I should have sold it a long time ago. The story changed a long time ago. But there was one factor. I kept it for one reason. And I held it. And I always thought there's that company, if they ever pivot and they look at this area, in other words, it still had potential. That's why I held it. But I sold it today, and I basically said, the reason why I sold it is because we're getting close to the last 2 to 3 years. Okay. So I gave him a long rope. I gave him a long rope to basically tell everybody that if the gold price goes up, we're gonna do this. And they haven't. I'm not gonna tell you the company. I'm not gonna tell you the reason. But I'm just telling you that I gave him a long rope. But today I sold him. And I basically said, okay, we're at the end run. Now we got
Yeah.
2 to 3 years left. I only want the stocks now that I like. I've sold about 10 dogs in the last year. I'm slowly whittle the dogs. So what I do is, if those are stocks that the story has changed, so I sell those and then I go buy another one. I just replace them. But now it's becoming harder to replace them.
Yeah. Well, I love that you've got a strategy behind it, right? You're looking at the story. You're looking to see what the fundamentals of that company are, what their
Right.
situation is.
Yeah.
I'm sure you're looking at the price action as well to kind of understand what's happening. But
All 165 of those stocks, I believe, have a good story, that have a good potential. Now,
Yeah.
he's like, how can you find 165, Don? How is that possible? Well, we could sit down and I could show you each one and tell you why. Now, of those 165, I'm just hoping that 100 of them, I don't need all 60 to do extremely well. I just need about 100.
100 of them, okay.
Yeah, if 100 of them do really well, then the other 65, they can do pretty good. They don't have to do well, but I firmly believe that 50 of the 160 are going to do extremely well. So the first 50 do extremely well, then the next 50 do well. That's the whole plan. That's the 7-bagger, if you will. That's what I'm after. But if I get that 7-bagger, I'll be very happy. Again, when I wrote my book, I wrote it in 2010, I believe. In that book, in the opening thing, I say my plan is to be a 5-bagger. That's what I'm after. If I can be a 5-bagger, I'll be happy. But now I've upped it to a 7-bagger, and if I was patient, I could easily get a 10-bagger. I believe, if I wanted to, if I was patient and I was going to wait it out, I believe that that's possible. So anybody that's starting today, I believe could easily, at least a 3-bagger, probably a 5-bagger. If you don't own any stocks, I think easy 3-bagger, maybe 5-bagger is my expectation. And if things go nuts, if silver goes to $250 or $300, you're going to even do better than that. I mean, you could get a 10-bagger if you focus on silver miners.
I think it's gonna be an awesome wave to ride here. It's already been pretty incredible just the last 12 months.
It has been.
And I don't think anybody's seen anything yet, but I do want to say, as you mentioned, be prepared for pullbacks. We are going to have pullbacks of 20%.
Yes.
We may even have them close to 30. So you got to get ready for it.
Yeah, people have no idea how volatile these miners can get. I was down 70%. My portfolio was down 70%, 70 in 2008. And then it was up 100% in 2011. Down 70 to up 100. Yeah, it's pretty crazy how volatile it's getting. So the thing that people don't realize is the silver miners are going to have uber volatility. I mean, we saw silver go down $3 in one day. I believe we're going to see silver go down many times, $5 in a day, and even $10 in a day, possibly $20 in a day. And the reason why is because there's not enough of it.
Yeah.
And so
yeah. Yep.
So we're going to have shortages. And so basically governments and regulatory agencies are going to play games to basically control supply. They're going to do stuff. And when they do stuff, you're going to see volatility because there's not enough silver out there. But whatever they do, I think worst case, that maybe they could push it down $20 in a day. But worst case, every time they push it down, it's just a matter of time before it starts going back up because they can only do so much. They can't print
That's been
silver.
the whole story this whole year. Every time, like every flipping Monday, we wake up and they've tried to shove it down, and it worked for a few months, and for the last 4 months, it hasn't worked.
Right. There's a lot of stuff they can do. I think the low-hanging fruit, the first thing that they will do is they will make it really difficult for the futures markets. They'll keep increasing the margins. That'll create a lot of volatility, and that'll slow the price down and trading. That's the first thing they'll do. Then the other thing they can do on the trading market is they can make it where you can't do delivery. You can only buy, you can't sell. They could do that. But then they could empty the ETFs. I think that's coming. You're looking about 700 to 1 billion ounces of silver that could literally get dumped on the market. Now that would probably create a 6-month glut before silver would start going back. But they can only do that once. They can only do it once. Then the other thing they can do is the kind of the nuclear option is they can prevent you from buying silver. The retail level, they can basically say, you can sell all you want, but you can't buy any.
Or when we get to the digital dollar, depending on when that happens, they could also restrict the ability to use that. To go.
So they're going to play their games, and silver's going to get up and down, up. It's going to get, but gold, there won't be any games with gold. There's plenty of gold. You won't have any supply issues with gold. Price will take care of gold, but silver's got a big problem. So if you're overweight silver, get ready to hang on to that bucking bull, the silver bull. You're going to have to hang on tight because it's going to go up and down, up and down.
Yeah.
And so that's one of the reasons you want to sell to the top on silver. You don't necessarily want to wait till $100 silver to take your first profit, because we could go to 90 and then they could dump the ETFs and it could go all the way back to 65, and you're going to wait 6 months for it to get back to 90. So 80, 90, I'll take profits on silver, 80, 90, and 100. That's the plan. I'm not going to wait till $100 silver to take my first profit, but I probably won't take any until 75 or 80. I won't sell any miners before 75.
I'm getting the consensus of that from a handful of other charting people as well.
Yeah,
that's about the range.
Yeah, I won't sell before 75. Get to 75, and then I'll look around and say, okay, maybe I'll take something. But right now, my target is 80 as a starting point. And then gold, it's 5,000. Got it.
I love it. All right. Well, everybody, I want to thank you guys for watching. Don, I want to thank you for coming on. And until next time, everybody, peace out and leave a comment down below. Talk to you soon.